Hello and welcome to our economic briefing. The Bank of Korea has just released its final economic outlook for the year. To discuss the road ahead, I'm joined by Bomin covering the domestic economy and Seungmin covering the global landscape. Welcome.
Thanks for having me.
Glad to be here.
Let's start with the headline projections. Back in August, the growth projections were 0.9% for this year and 1.6% for next year. What are the latest forecasts for growth and inflation?
To put it concisely, we're looking at an improvement, though inflation remains slightly higher than expected. We project GDP growth to land at 1% this year and 1.8% next year, then expand slightly further to 1.9% in 2027. The second half of this year has been volatile. Growth came in strong at 1.2% in the third quarter, supported by government consumption vouchers and robust semiconductor exports. However, we expect the fourth quarter to slow to 0.2% as base effects kick in and exports of tariff-affected products face headwinds.
Regarding that 1.8% forecast for next year, does that assume the construction slump finally bottoms out?
Yes, construction investment is expected to contract by 8.7% this year before turning positive with a 2.6% increase in 2026. Combined with a recovery in private consumption, domestic demand should provide support to overall growth alongside exports.
That sounds promising for growth, but what about the price tag attached to it?
On the inflation front, we project CPI inflation to run at 2.1% for both 2025 and 26 before reaching our target level of 2% in 2027. Although global oil prices are stabilizing on the back of increased supply, the weak Korean won and improving domestic demand continue to exert upward pressure on inflation.
Now let's turn outward. The report notes that the global economy is doing better than expected despite ongoing trade tensions. Seungmin, how is this possible?
It's a bit of a paradox. Despite higher tariffs and heightened trade uncertainty, the global economy is doing better than expected. A significant part of resilience comes from the US, where growth is forecast at 1.9% this year and 2.1% next year, before moderating to 2% in 2027. The primary driver is, of course, the massive AI investment by big tech. But our analysis shows another key factor. The actual shock from tariffs was smaller than feared. Companies stockpiled inventory before tariffs hit and utilized the exemption effectively. Hence, the effective tariff burden was lower than the headline rate suggested.
That's interesting, but even if businesses have dodged a bullet, inflation still seems to be high. Could you elaborate on the factors underpinning the growth in US consumption?
That brings us to the wealth effect. The AI boom fueled a massive stock market rally. This made households, especially middle to high-income ones who own stocks, feel wealthier, which directly boosted spending on discretionary items like travel and leisure. On top of that, the Fed's rate cuts in September and October have brought real interest rates closer to the neutral level, further supporting domestic demand.
So the US is powering through. What about China?
China is also better than feared, with growth forecast at 4.9% this year. This partly reflects the slight easing of trade tension with the US, specifically with the fentanyl tariff reductions, as well as China's efforts to diversify exports to non-US markets such as ASEAN and Europe.
Let's bring it back to domestic demand. Bomin, what's your take on domestic consumption?
We're seeing a gradual improvement. Private consumption is expected to grow by 1.7% in both 2026 and 27, bolstered by real income gains and supportive fiscal measures. However, there is a structural ceiling. Our analysis shows that despite the recovery, the household savings rate remains structurally high, acting as a drag on spending.
It appears that the propensity to consume has remained low for nearly a decade. Why are people saving more instead of spending?
It stems from a combination of three factors: the burden of accumulated debt, demographic shifts, and the lower potential growth. First, the burden of leveraged debt. We found that the excessive accumulation of household debt since 2013 has structurally reduced private consumption growth by about 0.4 percentage points annually. Unlike in the major economies, the wealth effect in Korea is very weak. Rising housing prices don't lead to more spending. Instead, they force households to tighten their belts to pay down huge principal amounts or save aggressively to buy a home.
So rather than feeling richer, household feels squeezed by future housing costs.
Exactly. It's become a chronic condition that limits private consumption. Second, demographics. As the population ages, the proportion of people in their 50s and 60s who have a high propensity to save for retirement is increasing. And third, lower potential growth. With potential growth slowing and life expectancy increasing, households are engaging in precautionary saving to secure their future.
It seems the household sector is facing significant structural headwinds. Does the construction sector, which weighed heavily on growth this year, offer a better outlook for domestic demand?
Fortunately, yes. We believe the construction slump is bottoming out. Construction investment plummeted by 8.7% this year, which has been a large drag on the economy. But we see a turnaround to 2.6% growth in 2026. This recovery will be driven by the resumption of stalled projects and an increase in government SOC budgets.
So domestic demand is stabilizing, but it still faces structural headwinds. This suggests our growth path is still significantly weighted towards the export sector. Seungmin, the report highlights the global semiconductor market. Are we seeing a sustained expansion phase?
It looks that way. The market is in a supplier-driven expansion phase. High-performance chips, HBM, are witnessing rapid growth that continued from the first half into the second half. What's also interesting is the legacy sector. Because manufacturers are concentrating capacity on HBM, the supply of legacy chips is constrained. This shortage has caused prices for general-purpose chips to rise sharply recently.
It seems governments are driving this as much as companies.
Exactly. It's the era of sovereign AI. Governments worldwide are rushing to secure AI sovereignty, leading to a sustained investment from both the corporate and the public sectors. However, the path ahead is not without peril. We see significant risks on both sides. On the upside, the expansion of physical AI could drive demand even higher than we expect. But on the downside, there are growing fears of AI overinvestment and the potential for the US to impose tariffs on IT devices and semiconductors.
So the uncertainty is quite high. Bowman, considering that the semiconductor sector remains a dominant variable for us, how do these global risks translate into our economic forecast?
They are important factors. Given the high uncertainty, we analyzed 3 scenarios. First, the base case, which is the scenario for our headline projections. We assume chip export volumes slow to about 7% growth next year and 5% in 2027 as US tariffs kick in from the second half of 2026. Second, the optimistic scenario. If the United States holds off on chip tariffs and the AI boom continues, GDP growth could jump by an additional 0.2 percentage points next year and 0.3 in 2027, while inflation edges up by 0.1 percentage point in both 2026 and 27. Third, the pessimistic scenario. This is the AI bubble fear. If global AI investment cools down, growth could fall by 0.1 and 0.3 percentage points in 2026 and 27. As for inflation, the impact would be limited in 2026, but we estimate a 0.1 percentage point drop in 2027.
So the recovery may feel different depending on where you stand. Before we wrap up today's briefing, if you could leave our audience with one final thought.
I would say trade policy is still in play. While recent agreements have mitigated some immediate risks, the broader trade and tariff landscape will continue to influence our outlook. This is outlined in our scenarios. The implementation of the Korea-US tariff agreement and the possibility of further US action on IT and chips will be decisive for our export performance in 2026.
For me, it is asymmetric recovery. The headline growth of 1.8% is positive, but it masks the struggles of the non-IT sector. The growing divergence between the semiconductor sector and the rest of the economy warrants close monitoring.
With solid growth projections and stable prices on the horizon, the stage is set for the Korean economy to regain its vitality. We will be cheering for that progress. This concludes today's briefing. For further information, please refer to Bank of Korea's website. And of course, we would appreciate it if you could also like and subscribe to our YouTube channel.
Thank
Thank
you.
you.